Hey, what's up, guys? It's Jonathan here. So, recently we've seen some key indicators in the market that might make it a prime time to start buying growth stocks. So, in this video, I want to discuss some of these indicators, the four top growth stocks that I'm looking at right now. So, if any of this information provides you value, please consider hitting the like and subscribe button, and let's get right into the video. So, right now, I think is a really prime time to buy growth stocks, and the main reason for this is inflation. So throughout 2021, we've seen the inflation reading run up to the 5.4% year over year reading we've seen in July 2021. But just recently, we've got the inflation readings for August. And we're starting to see a reversal of this trend, with August's year over year inflation reading coming in at 5.3%. In my opinion, I think that this is only the start for us to start seeing inflation deflect down. And you're probably thinking, what does interest rates have to do with growth stocks? When you invest in growth stocks, you're invested in future earnings because most growth stocks usually don't have earnings. And if there's widespread belief that inflation will continue to run to the upside, this belief could cause those future earnings to be devalued at a lot greater rate than when the belief is that we'll just have normal 2 to 3% inflation. So if we start to see inflation readings come in lower, that will most likely change the market's prediction of future inflation, causing growth stocks to head to the moon. So with that said, let's now talk about the four top growth stocks I'm looking at right now. The first stock I'm looking at right now is Enphase Energy. Basically, they're a solar company that installs solar systems for resident and commercial use. And what makes Enphase different from other solar companies is that instead of manufacturing all the different parts of a solar system, especially those commoditized pieces that have very low margin, kind of like solar panels, what Enphase focuses on is manufacturing their higher margin inverters. And what makes their inverters special than the normal inverters that are used out in the market, they allow the solar panel array to run a lot more efficiently, leading to a shorter payback period for their residential and commercial clients, which overall makes solar more affordable for the average person. And in their most recent earnings call, the CEO of the company stated that demand for these microinverters are well ahead of supply. The shortage in supply that Enphase is facing is mostly caused by a semiconductor shortage. The general consensus is that the shortage will begin to resolve itself in late 2021 or early 2022. Given that their plan is to build 2 more inverter factories in Mexico and India, in my opinion, this company is going to really run in the next couple of quarters. So after spending some time running my numbers, in my opinion, I think that in 2 years, this could easily be a $350 stock. So for me personally, I'm willing to buy this stock for anything under $220. So the second stock on my list is Amazon. I think most of us watching this video know what Amazon does, given that they have the most canceled CEO on planet Earth. If you've been living under a rock for the past decade, Amazon is a conglomerate and they're mostly known for their online e-commerce presence. But for me, there's 2 other parts of their business that I'm really excited for. The first part is Amazon Web Services. In the previous quarter, this portion of their business grew year over year at a rate of 37%. And given the mass adoption from many different companies to use Amazon Web Services, I see a lot more growth coming from this portion of their business in the future. Another part of their business that I'm really excited for is the Amazon Prime subscriptions. Over the past 18 months, there's been massive subscription pull forward due to the pandemic. But even with that, they're still continuing to have very high retention rates and very high growth rates as well. And with that as well, they're also able to add more features to the subscription as well, which will only make their subscriptions even more stickier than they already are. And given that AWS and Prime are 2 of the most profitable parts of this business, I can see the stock trading for $5,500 a share in about 2 years' time. So for me, I'm willing to buy this company as long as it stays under $3,800 a share. So the third stock on my list puts to G in FANG, which is Google. And again, like Amazon, they're another giant conglomerate. And there's so many different parts of their business to be excited for. So for me, I'm really excited for their YouTube revenue numbers. And so far in 2021, they have doubled their YouTube revenue compared to 2020. And 2020 was a huge year for YouTube as there's more people on the platform than ever. And being a creator myself, I see that there's so much opportunity still left in YouTube. I see a lot of opportunity for YouTube to grow even more in the future. and in turn more money for advertisers to spend on the platform. So in 2 years, I could see this being a $4,000 stock. So in my opinion, I wouldn't pay any more than $3,000 a share to own this stock. And it's definitely fair to say that this is probably the least bullish on my list, but it's definitely not a company that I would bet against. So the fourth stock on my list is LMND. And LMND is an insurance company with products that are geared to millennials. Their biggest selling point is how they're able to incorporate text into insurance underwriting. And one of the interesting things that they actually use consumer behaviors on their website to determine how much of a risk a certain individual will be to insure. So one of the things they look at is, let's say you sign up for LMND insurance and you don't look through their terms and service. They would consider you to be more risky versus if you did read through their terms of service, which is something that I don't think any other insurance company is doing out there. And another thing that I really like about this company is how they plan to grow with their target audience of millennials. So initially, LMND started off with rental insurance, but slowly over the years, they've grown their offering to many different other insurances. Right now, the newest insurance that they're working on is car insurance. And I think that car insurance will really drive revenues up in this company. So to make sense of the company's valuation, I have to do about a 4-year look ahead, which the further you have to look ahead to determine a company's valuation, the more risky it becomes. So let's keep that in mind. But I think that in 4 years' time that this company could easily be a $150 to $200 a share company. So for me, I'm willing to buy this stock anywhere in the range of like $60 to $65 a share. But once it gets past $70, I'm probably going to stay away from this one, especially given the heightened risk that comes with this stock. So as usual, none of this is investment advice. So if you invest in any of these companies and lose money, that's your fault. So thank you for watching. So if you enjoyed this video, please hit the like button for YouTube algorithm. Also, I was just looking at my analytics and I realized that 95% of you guys are not subscribed to this channel. So what are you guys doing? Hit the subscribe button and notification bell so you get notified anytime I post a new video. Also, follow me on all my socials. I try to post there every day. And thank you so much for watching. I'll see you in the next video.